Hello and welcome into this lesson. So, this lesson we are going to be discussing what fair value gap is, and probably you might have heard about a fair value gap. And a fair value gap is an ICT concept that the ICT mentor or creator was able to come up with as ways of showing or making since since the purpose of the market is to rebalance and also to run liquidity. So while the market is rebalancing, we have to understand that the market usually tends to rebalance inside the fair value gap, and also sometimes also the market tends to run liquidity inside the fair value gap. So I'll go directly to the charts and show you an example of the fair value gap. And the fair value gap also is not limited to there's a specific time zone. It is available at every time zone, in the weekly, in the monthly. It is available at different intervals of time. So this is the daily chart. So when you see me using the daily chart, remember the fair value gap can be seen in the 15 minutes, in the seconds chart, in the hourly chart, in the daily chart, weekly chart, all intervals. So I'll just outline different examples of fair value gap, and a fair value gap is used to show levels of, let me say, imbalance or areas of imbalance where the market left with high volatility or there was a high level of expansion. So the market left that a specific area, let me say quickly or with high speed, if I may term it as that, and leaving these levels of imbalances where now we have so like here we have a fair value gap. Here we also have a fair value gap. We also have a fair value gap. So a fair value gap is a level of imbalance or a level of inefficiency where the market did not trade efficiently. And by efficiently, I mean the market did not come back to rebalance and it was left open. So sometimes it may be left open and some imbalances may be rebalanced, but not all imbalances are rebalanced. Like here, for example, we see that so far this area has not yet been rebalanced. So there's a level of inefficiency in this area. In the second one here, we see that the market later came and rebalanced inside of it. Here in this area, the market also came and rebalanced here. And also another thing to note about the fair value gap is that a fair value gap can be used more than once. So we see like here, we traded into it once, twice, and we came back and traded below it. Here we traded below. So the fair value gap in short is used to also to show direction of the order flow in the market is, if the market is respecting a particular order flow, and we can be able to gauge using the fair value gap whether the fair value gap is providing support or resistance to the market. So we can see that, remember another key thing about the fair value gap is that the fair value gap may be traded into and away from. Like what I mean is this, like we hit it once here, then we traded away, then we hit it again, ran sell side liquidity inside it, then traded away, and then we hit this fair value gap again, filled it and traded below it. So this you just have to, as a trader, to anticipate. And how do you now distinguish what price will do in this particular fair value gap is understanding higher time frame order flow. So we cannot trade these levels of imbalances blindly. So for example, you see this daily chart here. So I'll go into the 1 hour chart or the 15 minutes to be able to show you maybe another or other imbalances around this area, to be able to make you understand that we cannot just come into the 1 hour chart or the 15 minutes chart and outline a fair value gap and expect that every time we'll get a bounce off of it. But we have to understand that these fair value gap are used to confirm particular order flows in regards to the higher time frame. So let's go into the 15 minutes chart. At that particular point, for example here, when we hit the fair value gap the first time, this daily fair value gap, so we'll be able to see that in the 1 hour chart here, this is the 15 minutes, sorry, the 15 minutes right here, we had multiple imbalances, like here, the first one, this is the first imbalance here, the second, is there an imbalance here? No, there's a second one here, and also there's a third one here. So we we cannot just come and enter into these fair value gaps just when we feel like it. We have to understand first the higher time frame order flow to be able to know and let this fair value gap in the lower time frame to work in our favor. So I can see like here, it seemed like we got to retest this fair value gap, then we moved away. So in the lower time frame, we have very many imbalances compared to higher time frame. But as I said, these imbalances from any time frame, you have to understand the time frame higher than the one that you want to trade, what the market is doing first, to understand it, so that you may be able to use the fair value gap. And also a fair value gap can be passed right through it. Like for example, if I extend this, you see that the first time it was retested, but the order flow seemed to be maybe bullish. So we came into this imbalance and closed above this fair value gap. And you can see how this middle point of this fair value gap was used to, the bodies used to retest it, then move higher into the bullish side. So as I said, we have to understand for fair value gap, we have to understand the higher time frame first before using any particular fair value gap. But fair value gap can be used to provide support and also resistance in the market. Yeah. So that's it about fair value gap, and I'll see you in the next lesson.